Thank you very much. Thanks everyone for hanging on. I'll try and get everybody off to lunch promptly. It's very nice to be invited back. We've been at this event a few times over the years, and it's always interesting to hear the stories of so many of our listed issuers, but the mining industry in general. I should say I'm, unlike probably everybody else here, not a mining expert. I work for stock exchanges. My current gig is with the Toronto Stock Exchange and the TSXV, so sort of ex officio I come into contact with a lot of mining people, mining companies and mining information, but bear with me, I'm not qualified. So I'm going to do two things. One I'm sort of going to go through the standard mining market and mining update that we like to do at this event every year as we approach the end of the year. But at the end of it, I'd sort of like to branch off a little bit and be a bit more speculative or questioning about what on earth is happening in the markets. So the first bit is the corporate story. It's a great story. Canada, as everyone should know, and as Anglos's slides from, Ray Dalio pointed out, is a very stable, comparatively low debt economy, has a very sound banking system, an excellent regulatory environment, and generally recognised as being a good place to do business. So it's a great place to have the Toronto Stock Exchange. The second thing I'd like to point out is that I've been working for TSX for about 10 years now, and over that period, the relative importance of the Canadian capital markets, particularly the equity capital markets, I think has really changed. A lot of money is raised in Canada and has been raised over the years and continues to be raised. I'll talk a little bit more about a bit more detail on that as we go on. But one of the things that's really different now from 10 years ago is that the London Stock Exchange and AIM, compared to the Toronto Stock Exchange and the TSXV, they're pretty much the same in aggregate market cap. 10 years ago, London was 2 or 3 times bigger. Now we're about the same size. On any excuse me, on any given day, you know, it's going to vary a little bit, but Toronto is as big as London in equity capital market terms generally. That's across the whole market, not specific to mining. But that, I think, is a real change. And Toronto is also, I would say, challenging London in terms of international listings now. We have a lot of international companies listed with us. And I think one of the sort of badges of achievement is that our biggest international market is in fact the United States. So in some ways that makes sense, they're right next door, but in other ways you think this is a bit counterintuitive, because why would an American company, why would a company from the United States list in Toronto when they've got NASDAQ and the New York Stock Exchange as their domestic platforms? There are all sorts of reasons for it. I'm not going to go into detail now, but I think the main thing is that Canada's markets, the Toronto markets, offer a genuinely viable platform for comparatively small and comparatively young companies, much more so than the US markets. And I stress the word comparative. A $1 billion market cap company on NASDAQ is not going to get noticed. A $1 billion market cap company on the TSX is certainly going to get noticed. So it's not just the very, very small companies, not just the juniors, but really quite, we're marching on here, really quite large companies can benefit from the sort of the relative scale of the Toronto markets, I think. So that's Canada broadly at a high level. I'm going to talk a bit about mining. Please do bear in mind what I said at the beginning. Our mining market is incredibly international and continues to be so. We reckon over the 1,100 listed mining issuers on our market, there's about 5,200 mining projects being operated at various different levels of maturity around the world, and nearly half of them are outside of Canada. Unsurprisingly, an awful lot of them are in the United States, but they're all around the world. The Canadian market, particularly for mining, is a genuinely international venue for raising money and for mining companies to tell their story. an awful lot of gold companies, but just about everything else. And we've heard some really interesting stories today about other mining companies engaged in looking for things other than gold. But I think we retain a very, very strong position in the gold mining finance community. These figures are all as of the end of 2023. So the figures on the screen are a bit out of date, but I have some more up-to-date information. So in 2023, $7.5 billion was raised by our mining issuers. Up until the end of September 2024, so the first 3 quarters of this year, it's $8.5 billion. So we're probably on track to see something like a $10 billion aggregate amount raised by mining companies listed in Toronto this year. That's probably that's a pretty good year. It's not the best, but it's certainly a very good year. What's really interesting is that it represents over half of all the money that was raised in Toronto this year, up to the end of the third quarter. It's $8.5 billion raised by mining companies out of $16 billion raised in total. So mining is really, really, really important to the TSX and the TSX Venture Exchange. It's absolutely our franchise and the sort of backbone of our business. My colleagues are always keen to diversify, and we should be doing more in technology, and different trends come along: cannabis, blockchain, gambling, gaming companies, AI, etc., etc. And of course, they're all important, but mining is always there, even in difficult years. I think Toronto's strength kind of shines out, perhaps even more so when the markets are difficult. So, as I say, this year, $8.5 billion raised by mining companies, and $2.5 billion of that raised by companies on the Venture Exchange. So I know I'm not trying to tell people that their lives are easy. What I'm trying to say is that the market is functioning, and compared to any other public market serving mining companies, I think it's functioning at least as well and better than most. We have a very good market share of mining. We don't have, a monopoly, but over the past 5 years, more than 1 in 3 of more than a third of all the money raised by public mining companies in the world was raised in Toronto, and we have kind of approaching 50% market share by number of transactions, if that's important. Our challenger, our close competitor, and I'll come on to this a little bit more in a moment, is Australia. Over the last 5 years, we have raised more money than the ASX for mining companies. Actually, last year, I don't know if this is the slide, no, I'll come on to it in a sec. Actually, I'll go and look at it now and then come back. Last year, so these are the 2023 figures, you can see that the amount of money raised in Toronto was 7.7, and actually for the first time in living memory, the ASX beat us. But I think this year the trend has reversed. But really, I mean, those are, I would say, the only 2 markets that really function on a sort of a consistent and continuous and to some extent reliable basis. The thing that I think was quite shocking last year was how little was raised on the London markets and the US markets by comparison. So Toronto is very, very important. I mentioned the Venture Exchange and the fact that quite a lot of the money raised so far this year, and every year, is raised by the juniors. I think this junior-senior market structure that we've got on the Toronto markets is really important. I think it's unique. It really works. The Venture Exchange consistently produces numbers of companies that grow, that then graduate and move on to become, in some cases, very large companies. We've got, someone like Wheaton began on the Venture Exchange, for example. Over half of all the mining companies on the TSX began their lives on the on the Venture Exchange. Other exchanges have a similar sort of junior-senior structure, but I think it works better in Toronto than it works anywhere else. And I think that's one of the reasons, probably the main reason, why companies from the United States and from all over the world, and some of the companies that we've got here today, are attracted to the Toronto market. I'm not saying other markets don't have their advantages, but this is something that is very, it's kind of unique to us. We looked at this one already. So that's like the corporate stuff, which I've got to say. I mentioned that the money raised this year is quite good. So far in the first 3 quarters, 8.5 billion Canadian dollars, over half of all the money raised. But I also know that companies are really, lots of companies are finding it very difficult. And one of the areas that I think is where this sort of difficulty is really coming to light, and this is now kind of my personal view rather than TMX's corporate statements or anything like that. The number of IPOs all over the world is really, really down this year. In London, in Canada, in Australia, even in the United States. Probably the United States is doing a bit better in terms of new IPOs, not just in mining companies, but in companies. The IPO industry is kind of having a very thin time. For me, this hurts because my job as the business development manager for Europe, Middle East and Africa is to get companies to go and list in Toronto. And it's hard. There are lots of companies that I think would like to do it, but it's hard for them to do it at the moment. And it's silly to pretend otherwise. It might be about to change. We've just this week, a company called Apotex in Canada has filed to do I think it's a $1.5 billion IPO. It's sadly not a mining company, it's a pharmaceutical company. But they're going to try and do a significant, by Canadian standards, IPO. If that goes well, that might be something that will sort of open the door. But it does seem weird that the IPO market has become so difficult when, you know, let's face it, share prices are higher. Indices are at or close to all-time records. In this industry, commodity prices, particularly gold, very strong. You would think it would support a lot of a reasonable level of IPO activity. And I think one of the things I think may be affecting this is that over the past decade, there's been a really strong move towards passive investment as a style for all sorts of investors, not just retail investors. There was a study came out recently by Goldman Sachs that showed in the US market over the last 10 years, passive funds had seen inflows of about $3 trillion. This is passively managed equity funds, ETFs and other things. And over the same period, actively managed equity funds had seen an outflow of about $2.8 trillion, so very close. And we all know that passive funds perform well, or they're very useful instruments for a lot of investors. But I think one of the sort of unexpected, or maybe it should have been expected, side effects is that active fund managers don't have a lot of incoming liquidity. So to go and buy into an IPO, they haven't got a lot of undeployed cash awaiting opportunities. It means they've probably got to sell something to buy an IPO, and that's a lot harder than just to use the cash that's at hand. So I think that's perhaps one of the factors. Of course, over the last few years as well, private capital has been a lot more available, and for a long time, debt, in some cases, was very, very affordable. So there were competing sources of financing for new companies, and that has had an interesting effect. These days, it's very fashionable to have a conspiracy theory, so I've got a conspiracy theory as well. Regulation doesn't get less, regulation gets more, and it's always well intended, I guess, to improve transparency, to improve disclosure, to improve corporate governance on the company side, and at the sort of macro prudential regulation side. There have been things certainly in this country, but I think in other places as well, that encourage pension funds and banks and insurance funds particularly to invest less in equities and more in fixed income, more in bonds. So all these sort of regulatory and jurisdictional factors together have sort of made it harder for companies to be listed and harder, certainly for some investors, to buy shares in listed companies. I think it's all well-intentioned, but when I get the conspiracy theory warmed up, maybe regulators would quite like public markets to be less important, because then they won't have the prospect of failure or scandal or any bad news, and it will just make their lives easier to manage if public markets go away. I don't really think it's the case, but you know, it's a theory. ASX and the London market. One of the things that's been notable for us this year is that the trend for Canadian companies to go and list in Australia, because up until 2023, Australia seemed to be a more welcoming environment for people to raise money, mining companies in some ways. That trend has been reversed, but quite a lot of it has been driven by sort of M&A transactions. So you've had people like Westgold, who bought Karora, and Paladin, who've got a deal waiting approval with Fission. Southern Cross did something with Mawson. But there have been also other just straight cross listings coming from Australia, people like Challenger Gold and Mithril Silver. So these, I think they're hugely important, but these flows, up until last year, there was a bit of a flow from Canada to Australia. This year it's very definitely in the other direction. So from a Canadian point of view, that's interesting and positive. I seem to be going backwards before I go forwards. And the last thing I wanted to mention, which I think might be sort of broadly bullish for the mining sector in a small but meaningful way, is, I said new developments. Saudi Arabia seems to be getting very interested in mining. I don't know if anyone here has been to their Future Minerals Forum, which is a big mining conference that goes on in January in Saudi Arabia. I went for the first time this year, and it was really encouraging. They produced a little mining booklet, and it said on the front, a little conference booklet, and on the front of it said, "Mining is the third pillar of Saudi Arabia's industrial development." And I thought, isn't it nice to see a country, and a pretty rich country at that, recognising how important mining is going to be, not just to make money, but for their industrial development. I thought that was a very encouraging thing. Saudi has made some big investments in Vale-based metals, for example, and they seem to be looking at projects. And we've worked with the Ministry of Mining from Saudi Arabia in Canada a little bit to help them just sort of get to know the mining industry. They are trying to build a mining industry from the ground up, from a very, very, very low base. And I think it's wonderful to see that happening. So I think there's probably opportunities for mining. I think they hope to be big consumers of human capital in mining. They've got, so they say, good geology. They've certainly got some finance. What they don't have is knowledge, expertise, experience, and they're trying to import that into Saudi Arabia and work with junior companies. I was surprised, but they're very, very keen to know the junior market better. And I think this is maybe, hopefully, an encouraging sign for the industry globally, really. If that does happen, I guess Canada should get their share of the benefit, because we're big in the industry. So with that, I will stop and release you for lunch, I hope. Stuck the technology.